The market didn't see it coming, or maybe they did, but they hoped it wouldn't happen. On December 19th, 2025, the Bank of Japan pulled the trigger. They raised their benchmark interest rate to 0.75%, the highest level in 30 years. And Bitcoin? Bitcoin is bleeding, trading around $87,000 as of this morning, down 30% from its all-time high of $126,000 hit back in October. This isn't a correction. This is a liquidity crisis. And if history is any guide, we're not done falling yet. Let me be brutally honest with you. Every single time the Bank of Japan has raised rates since 2024, Bitcoin has dumped 20 to 31%. Every single time. In March 2024, Bitcoin fell about 23%. In July 2024, it dropped 26%. In January 2025, it declined roughly 31%. The pattern is undeniable. The mechanism is clear. And today, it's happening again. The question isn't whether Bitcoin will fall further. The question is, how far? And the answer might shake even the most diamond-handed believers. The yen carry trade unwind. Nobody warned you about. Here's what they don't teach you in crypto Twitter spaces or YouTube comment sections. For years, Japan has kept interest rates near zero, making the yen the cheapest funding currency in the world. This allowed global investors to borrow yen and invest in risk assets, including Bitcoin. Billions upon billions of dollars flowed into crypto markets through this mechanism. Institutions, hedge funds, retail traders with offshore accounts, all borrowing yen at basically zero cost and buying Bitcoin, Ethereum, everything. But when Japan raises rates, that game ends abruptly, violently. The yen carry trade unwinds and investors are forced to sell their positions to repay yen-denominated loans. It's not optional. It's not emotional. It's mathematical. When your funding costs increase, your leveraged positions become toxic. You sell. Everyone sells, and the market crashes. Analyst 0x Nobler warned that every time Japan hikes rates, Bitcoin dumps 20 to 25%. And with rates now at 75 basis points, if the pattern holds, Bitcoin could dump below $70,000. That's not fear-mongering. That's pattern recognition backed by 3 consecutive data points over 18 months. The size of this crisis is bigger than you think. Let's talk about scale, because this isn't just about Japan's domestic monetary policy. Japan is the largest foreign holder of U.S. treasuries, holding over $1.1 trillion. When the Bank of Japan adjusts policy, it doesn't just affect the yen. It affects dollar liquidity globally. It affects treasury yields. It affects every risk asset on the planet, from stocks to bonds to crypto. The December 18th through 19th policy meeting wasn't a surprise. Polymarket assigned a 98% probability of a Bank of Japan hike, with only 2% wagering that policymakers would hold rates steady. The market knew it was coming. But knowing and pricing in are 2 different things. Bitcoin was already trading below $90,000 before the announcement. The announcement simply confirmed what traders feared. The liquidity spigot is shutting off. And here's the part that should terrify you. The Bank of Japan isn't done. Governor Kazuo Ueda made it clear during the post-decision press conference that further rate increases are coming. Real interest rates in Japan remain significantly negative, even at 0.75%. The central bank sees room to continue normalizing policy throughout 2026 and beyond. Why this time feels different and worse. Previous yen carry trade unwinds happened in isolation. March 2024, markets recovered quickly. July 2024, the drop was sharp but brief. January 2025, Bitcoin found support and rallied back toward all-time highs by October, but this time, the macro environment is fundamentally different. The Federal Reserve has cut rates 3 times in 2025. Bringing the federal funds rate down to 4.25 to 4.5%. Normally, Fed rate cuts are bullish for risk assets. More liquidity, lower borrowing costs, money flows into stocks and crypto. But when the Bank of Japan is tightening at the same time the Fed is easing, you get a divergence problem. When U.S. rates fall and Japanese rates rise, the yield advantage that supported borrowing yen to buy U.S. and global assets collapses. This accelerates unwinds, compresses leverage, and drains liquidity from speculative corners of the market. Crypto is ground zero. Bitcoin is currently trading around $87,000. This represents a 30% decline from its all-time high of $126,210 reached on October 6, 2025. The psychological level of $90,000 broke days ago. The next major support level? Somewhere between $75,000 and $70,000, depending on which technical analyst you ask. Crypto analyst Crypto Nobler posted that if the pattern holds, Bitcoin will dump below $70,000 on December 19th. We're not there yet, but we're getting close. And if institutional selling accelerates, if leveraged positions start cascading into liquidation, $70,000 could look generous. The institutional exodus has already started. Let's talk about what's happening behind the scenes, because retail traders watching their portfolios bleed aren't the only ones feeling pain. Institutional investors, the same ones who championed Bitcoin as digital gold and a hedge against inflation, are de-risking aggressively. Bitcoin ETF flows have turned negative. Grayscale, BlackRock, Fidelity, all seeing outflows or significantly reduced inflows compared to earlier in the year. When institutions built positions at $60,000, $70,000, $80,000, they had conviction. But at $90,000 with the Bank of Japan raising rates and global liquidity tightening, that conviction wavers. They take profits. They reduce exposure. They wait. And here's the brutal truth about institutional money. It moves faster than retail. When hedge funds decide to de-risk, they don't post on Twitter asking for advice. They hit the sell button. Millions of dollars exit in minutes. The market gaps down. Retail traders wake up to liquidation notices. The mining sector is feeling pain too. Bitcoin mining companies operate on thin margins, especially when energy costs are high and Bitcoin's price is falling. Many miners accumulated inventory when Bitcoin was above $100,000, expecting further gains. Now they're underwater on that inventory and facing difficult decisions about whether to sell to cover operational costs or hold and risk further losses. Could this actually be bullish? The contrarian case. I know what you're thinking. 1,500 words of doom and gloom, and now we're pivoting to hopium? Hear me out. Not everyone believes this Bank of Japan rate hike spells disaster for Bitcoin. Macro analyst Quantum Ascend framed the situation as a regime shift rather than a liquidity shock, arguing that Japan raising rates coupled with the Fed cutting rates is extremely bullish for crypto. The logic? Policy divergence creates volatility, and volatility creates opportunity. If you can survive the drawdown, you position yourself for the recovery. Glassnode co-founder Negentropic wrote that the market is not afraid of tightening, but of uncertainty. And the normalization of Bank of Japan policy brings clear expectations to the global financing environment. According to this view, Bitcoin often strengthens after policy pressure is released, not before. The selling pressure we're seeing now is the market pricing in the worst-case scenario. Once that's done, once the yen carry trade unwinds completely, liquidity conditions stabilize. And when they stabilize, Bitcoin rallies. Historical precedent supports this to some degree. After the July 2024 sell-off, Bitcoin found a bottom within 1 week and rallied back strongly. After the January 2025 drop, Bitcoin recovered and eventually hit new all-time highs. The pattern isn't straight down forever. It's sharp sell-off, capitulation, consolidation, then recovery. But here's the difference. Those previous sell-offs happened during a broader bull market with improving liquidity conditions globally. This sell-off is happening with the Bank of Japan signaling more rate hikes ahead, with Bitcoin already down 30% from highs, and with institutional conviction shaken. The recovery might take longer, the bottom might be deeper. What happens next? The scenarios you need to consider. Let's game this out. 3 scenarios ranging from bad to catastrophic to surprisingly bullish. Scenario 1, controlled descent to $70,000. Bitcoin continues bleeding over the next few weeks. Leveraged positions unwind, panic selling accelerates. We hit $70,000, possibly touch $65,000 briefly, then find support. This represents a roughly 40% correction from all-time highs, which is actually normal in Bitcoin bull markets. From there, consolidation for several months, then slow recovery as the yen carry trade fully unwinds and stabilizes. Scenario 2, cascade to $50,000 or lower. The selling doesn't stop at $70,000. Institutional outflows accelerate. Mining companies capitulate and dump inventory. Retail panic spreads. We retest the previous cycle, high around $69,000, breakthrough, and fall toward $50,000 or even lower. This would represent a 60% drawdown from all-time highs. Brutal, but not unprecedented in crypto. The 2021 to 2022 bear market saw an 80% decline. Scenario 3, the dead cat bounce rally. Here's the wild card. Bitcoin drops to 75,000, maybe 70,000, then violently rallies. Why? Because everyone's positioned for more downside. Shorts pile up, leveraged bears get liquidated. Institutions who sold at 85 or 90,000 rush back in at 70, thinking they're buying the dip of a lifetime. We get a sharp bounce back to 85 or 90,000, trapping late sellers and crushing shorts. This rally wouldn't be based on fundamentals. It would be pure technical and positioning driven, and it would be temporary. But it could happen. The investment thesis hasn't changed, or has it? Let me be clear about something. The long-term bullish case for Bitcoin hasn't fundamentally changed. Limited supply, 21 million coins maximum, increasing institutional adoption, sovereign nations adding Bitcoin to reserves, these factors remain intact. The halving cycle, historically a major driver of bull markets, still supports long-term appreciation, but the short-term macro environment is hostile. When Japan continues raising rates throughout 2026, when global liquidity tightens, when institutional conviction wavers, Bitcoin suffers. That's not a flaw in Bitcoin. That's reality. High-risk assets get sold first when liquidity disappears. Always have. Always will. The question facing every Bitcoin holder right now is simple. Do you believe the long-term thesis enough to endure short-term pain? Can you stomach watching your portfolio drop 30, 40, 50%? Can you avoid panic selling at the bottom? Because here's what history tells us. Every major Bitcoin bear market, going back to 2011, 2013, 2017, 2021, every single one looked like the end at the time. Every single one had capitulation, despair, predictions of zero, and every single one ended. Bitcoin survived, it recovered, it made new highs, but survival requires patience. It requires capital preservation. It requires not being over-leveraged when the market turns against you. The Bank of Japan just told us rates are going higher. Bitcoin is already down 30%. The yen carry trade is unwinding. This isn't the time for maximum conviction and leverage. This is the time for caution, for risk management, for understanding that sometimes the best trade is no trade at all. The bottom will come. It always does. The question is whether you'll still be in the game when it arrives.